Hello, this is Mike Swanson of Wall Street Window right here. This is my May stock market update, and in it I'm going to talk about 5 stocks that are in the Nasdaq 100 that I think are simply doomed, in big trouble, no matter what the Nasdaq does. Now, this is a chart of the S&P and the Nasdaq, and everybody is talking about this triangle pattern that can be drawn on these two averages, and also on the Dow too. And most people are predicting an upside break that I'm seeing on Twitter and Facebook, and also in articles by chartists. And they're predicting that we'll break and we're going to run to the highs and just have a big leg up, sort of like what happened from September to January, just a surge. I can't make a prediction like that. I see no evidence, frankly, that that's going to happen. That's not to say the market can't break the triangle, though. It can break to the upside, but if it does, I just think we're just going to see, a 100-point run or something in the S&P, a rally for a couple weeks, and then have to come back down. And really, in the reality, I think we're really in an overall sideways market over the next couple months that really started when the market peaked out in January. So there's also the possibility, of course, that we have a downside break, and that's a high risk. It doesn't mean the stock market would crash. It does mean we'd probably drop down to, say, 2,500 or something on the S&P 500. 2,450 is even a possibility, but I think we would then bounce back up. So it's not necessarily doomsday, but such a drop would wreck some stocks that are in particularly vulnerable situations. And here we go to the 5 stocks I want to show you in the Nasdaq. First is JD.com, symbol JD. Now JD already is broken down. It fell through the summer lows last year, made a new low just the other week. But I want to show you the 2 indicators below because they're very important. The first indicator is dividing the price of JD with QQQs. That's the Nasdaq 100. This is in a downtrend. It peaked out last August. What this indicator does is it compares the action in this stock with the action in the Nasdaq 100. When this indicator trends down, it means this stock is lagging the market. That's important because stocks that lag the market, when the market is going up or sideways, tend to really fall hard when the stock market does drop. So if the Nasdaq were to fall just 5%, this stock is most likely to double or triple those losses. Very risky situation. Now, also a red flag on it, though, is on balance volume, which also has been in a downtrend. What on balance volume is an accumulation distribution indicator. By declining like this, it's meaning there's more sellers than buyers in the stock. Now, the way this indicator works is it's a running tally of the up days and the down days in the stock with the volume. So if you have an up day and there's 1 million shares traded, it'll say plus 1 million shares, the indicator. If there's in a down day and there's negative and there's 500,000 shares traded, it'll subtract. So now you've got 500,000 on the indicator, and once this indicator goes, negative trending, it means that volume's coming out. There's more selling on the up day, more selling on the down days, and there's buying on the up days. And this indicator is showing this distribution. Take these 2 indicators together, though, and it's a very troubling warning sign that if the stock market dips, JD is going to get smashed and lead to the downside. Another stock in a similar situation is American Airlines. It, too, is broken support. It's hanging around right under 43, but it's been lagging the Nasdaq since the beginning of 2017, and just recently on bounce volume has plunged. What this means is that the stock has limited upside if we do get the triangle breakout some you're predicting, but if the market breaks to the downside of that triangle, American Airlines is going to dump. It's going to lead to the downside, probably fall twice or 3 times the rate that the Nasdaq does. that means this is a very dangerous stock, and I wouldn't want to own it. In fact, I think right now is a good time to do a risk appraisal of individual positions in your portfolio, and if they have declining on-balance volume and horrible relative strength compared to the average, you may want to consider selling such positions, moving money into other things, or raising some cash reserves to use later. Another stock that can show you why this is such good advice and why it's still a troubled stock is Dish Network. Dish Network has been in a sharp decline, almost down 50% from where it was a year ago, but you can see relative strength has been in a sharp disintegration, but on-balance volume has taken a tumble, and when it was declining last summer, it was warning that this stock is in big, serious trouble. And despite the rallies in the markets at times, and this stock, when the market does dip, just goes into a collapse. It's a stock that, you know, a lot of people use Dish Network, but it's heavily in debt and has some problems and lots of competition, and no need to get into all that. It's what the chart is doing, and it's probably going to continue to decline like this. Another stock that has not yet broken down in price at all. It's still, in fact, above the February high, above the March high, is Broadcom, symbol AVGO. No breakdown yet, but the two indicators are sending a powerful warning sign, and this shows how these indicators can be used as leading indicators for the price action. So on-balance volume, sharp decline. Of course, relative strength and nasty decline, but that on-balance volume disintegration is very alarming, even though price has not yet broken support. It suggests to me that this stock is in high risk of breaking support and going into a steep dive, 10-15%, that will take people by surprise and own it. Any dip in the stock market, if the stock market breaks that triangle, this stock is going to lead to the downside. And even if you want to say, okay, I think that triangle break is a possibility of 1 out of 4, this is still, I don't think, worth holding. In fact, this is the type of stock you may even actually want to consider betting against. And that goes to our next stock, final stock, which is in the Nasdaq 100, which is Tesla. Tesla, of course, took a tumble in March. It then bounced. It's what I call a dead cat bounce. And I use that as an entry point. I take that back. I actually was short this stock before it dumped in March, because at the beginning of February, I did this analysis and I saw that on-balance volume was dipping and relative strength was showing that this was a danger stock that had high risk of breaking down, and it did. And now it's had a dead cat bounce, which I think is a good entry point to short it. I'm short this stock. I'm betting against this stock. I got long positions. Don't get me wrong. Not everything I do is about betting against markets or betting against stocks. I got long positions, but I also got short positions. I act personally with my own money as a hedge fund. I look for stocks I think can lead to the upside, but also bet against bad ones. And this is a bad stock on the technicals. Of course, it's in the news all the time. It's got an earnings report coming up. I'm very curious to see what happens. If somehow this stock managed to gap up on earnings, I actually may be considering adding on to my short position at some point. But it's a situation I'm watching. And on-balance volume, bad. Relative strength, bad. You do not want to be holding stocks with poor relative strength. And as I said before, I think it's time to go over holdings and do this type of analysis for every stock you own, because there is a danger of a May breakdown, even though we can all hope that the markets bust the upside of that triangle. But either way, we're still not out of the woods. Bulls aren't going to take control of the market in the sense that they're going to be able to rally the market to new highs this month and do anything after that. It's just a sideways situation, but in sideways situations, the bad stocks can turn into dangerous hot potatoes, and I ain't holding hot potatoes in this market right now.